So we have the long-awaited January 2023 CPI numbers coming in. Boy, are they interesting. Depending on what side of the aisle you're on, they're either optimistic or not so optimistic. So inflation is down month over month, 6.4 from 6.5 in December of 2022. But it is up 0.5% from expectations for January. So what that basically means is that what they were projecting inflation to come out to be, it was actually up 0.5% from that, which is pretty significant. Most economists and other financial analysts were anticipating that inflation would get a little stubborn around the 5% range. And we're starting to see that stagnation and that resistance from inflation sooner than that at the 6% range. This is concerning for the market and for other analysts and economists, and for us who are subject to the changes of the Federal Reserve's policies, because this could make the Federal Reserve more hawkish or more aggressive with their rate hikes. Let's dig a little further into the numbers, and then we're going to talk about how you need to be adjusting, preparing, and where the opportunities may be from there. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrower capacity, proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel, and uploading content on a daily basis to help you customize your blueprint for prosperity. So, as I stated already, the inflation numbers are down month over month, from 6.5 to 6.4 from December to January, but up 0.5% from expectations for January. Getting a little further into the numbers, housing costs are actually up 0.7% month over month and 7.9% year over year. Food costs are up 10.1% from January of 2022. So year over year, food costs are up over 10%, which is drastic. Energy costs are up 8.7% year over year, which is also really rough. So when you start to dive into these numbers, those of you who have been following the channel will understand, and it will click for you that this may be cause for concern if you are looking for an easing up on the Fed's policies with rate hikes. Because the likelihood is that Jerome Powell, the Federal Reserve, are going to see this as a sign of resistance from inflation and feel the need to likely raise interest rates in March. And the market has priced in, and most economists have priced in, that the Fed would possibly stop in their last meeting earlier this month, maybe another 0.25% rate hike in March at best, but worst case, or at least what they were expecting, was for the Federal Reserve to likely be done for this month of February. These numbers are likely going to lean the Fed into another rate hike and potentially a more aggressive rate hike. So instead of a 0.25% rate hike or a quarter basis point rate hike, we could be seeing potentially a 0.5% rate hike, depending on how the Federal Reserve interprets these numbers. They are down month over month, but some areas are still resistant, and some are even kind of growing, like food and energy, are getting worse. So some plus side numbers, used cars are actually down 11%, a little over 11% from January of last year. So this could be a golden opportunity for any of you who've been sitting on the fence of the car market, because I can tell you, I personally bought a vehicle in January of 2022, and it was depressing how much more I paid for that vehicle than it would have been in a normal market. So those of you who are sitting on the fence in the auto market, looking for used cars, your opportunity could be now, or even further down the line in the future. It could be getting better because the car manufacturing market is picking back up. Some of the supply chain issues that we had during COVID that were creating the car shortage are easing. And, interest rates are going up. A plethora of factors are contributing to used cars dropping to above 11% below where they were a year ago. So there's some opportunity there. When I have introduced the concept of forward guidance from the Federal Reserve, I introduced the concept to you guys that the Federal Reserve's policies are directly guiding you on where to put your money. So as I've just broken down with these numbers, we could be looking at a more hawkish Fed come March. And that means that the Federal Reserve is going to potentially be more aggressive with rate hikes. The vast majority of the other lending products and interest rates that are sensitive to the federal funds rate are going to likely go up. It's not a complete guarantee, but there's a likelihood. Credit cards and, auto loan rates, possibly mortgages, are all going to see a hike as the federal funds rate continues to climb in this fight against inflation. I've explained to you that dovish basically means that the Federal Reserve is looking to slice interest rates and allow more money to flow into the economy. Right now, that's not where we are. The Fed is going to likely stay pretty stubborn and maybe even more hawkish the next time we see them in March. So where's the opportunity for you in this? Well, besides the used car market, as I've taught you before on this channel, there's going to be a tremendous opportunity when it comes to deposit rates, savings, high yield savings, CDs, money markets, possibly even products like annuities are going to start to see some really attractive interest rates as the federal funds rate increases. It's going to give the banks more room to increase their loan limit rates, but also increase their deposit rates and become more competitive in that arena. And believe it or not, there could be a terrific opportunity because inflation, if it continues to trend downward and interest rates continue to go up, you could have a rare scenario where deposit rates could actually match or eventually even exceed the inflation rate, which is extremely rare. It's not very common. But if you can start to see 5 or 6, maybe even 7% CD and high yield savings accounts, with inflation chipping down to 6, maybe upper 5%, or even leveling off somewhere in the 6% range, then that means for the first time in a very long time, you could put your money into a deposit product with no major risk to your principal and actually keep up with inflation and not be forced to invest your money to do so and take that risk to do so. Now, I'm not against investing, but I am a proponent for the fact that you need to be financially educated and have a reasonable skill set, or at least be working with a very trusted financial professional who knows what they're doing to help you invest in these turbulent times. This is not the decade that we left in the 2010s, where almost anything you threw your money at went up. This is no longer that economy. It's no longer that investment market anywhere in the market for the most part. So this is an opportunity for those of you who may not be aggressively investing or investing at all to make strategic moves right within your existing banking relationships with CDs, high yield savings accounts, possibly annuities, money markets, these deposit products. Of course, annuities are insurance products. They are not deposit products, but they are very stable, fixed contracts that give you a solid interest rate. And it can be a great product for this time period, depending on your financial situation. Please consult your financial advisors or, bankers or whoever you're working with around this topic. I'm here to give you the information, to give you ideas so you can learn how to navigate through this economy, through these fluctuating times. Because, man, I tell you, even the stock market ended very, very mixed today because of the fact that the numbers are down month over month, but they're up higher than what was expected. And so it's really hard to read what's going to come from that. The stock market is extremely attached to forward guidance from the Federal Reserve and the Federal Reserve's policies. If the Federal Reserve comes out hawkish, the next time we see them, the stock market could turn into a bloodbath again. So you need to be watching this closely. I'm going to continue to bring you more of this information so you can keep up with this. But I had to drop this video after the dust settled earlier this morning when that information came out, just to give you an idea of where things are and to give you an idea of the type of moves you need to be making to keep up in this market, keep from losing too much of your purchasing power, or to steer your investments in a healthy direction until we can get a little stability in the market. I know this content was valuable for you. I appreciate bringing it to you. As always, I want you guys to stay focused, stay in motion. I'll see y'all soon.